Imagine waking up tomorrow and discovering that every country on Earth owes money. The United States, China, Japan, Germany, even the richest economies on the planet are drowning in debt. But here's the strange part. If everyone owes money, who is the creditor? Who exactly is collecting trillions in interest every single year? And why does the global system seem designed so that the debt never actually disappears? Because the deeper you look into modern finance, the stranger the story becomes. Governments borrow money that doesn't exist yet. Banks create money out of thin air. And the entire global economy quietly runs on a promise that can never fully be repaid. This is the story of how the world built a debt machine designed to run forever. For most of human history, money was something physical: gold, silver, coins. If a king wanted more money, he needed more metal. This created a natural limit, but everything began to change in the 17th century, when banking started evolving in Europe. Merchants needed safe places to store gold, so they deposited it in early banks. In return, banks issued paper receipts. Those receipts slowly became money. But bankers noticed something interesting. Most people never withdrew all their gold at the same time, so banks started lending more paper receipts than the gold they actually held. This was the birth of fractional reserve banking. And with it came a revolutionary idea. Money didn't have to exist physically. It could simply be created through lending. At first, this system seemed brilliant. But it also planted the seed of a much bigger problem, because if money is created through debt, then the entire economy must rely on ever-expanding borrowing. The next turning point came when governments realized something powerful. Instead of raising taxes immediately, they could borrow money instead. This idea took off in the late 1600s when the Bank of England was created in 1694. The deal was simple. The bank would lend money to the British government to fund wars. In return, the government allowed the bank to issue currency backed by that debt. This model proved incredibly successful. It allowed governments to spend huge amounts of money without needing gold or immediate taxes. Soon, other countries copied the system, and over time, central banks became the backbone of national economies. But the consequences were bigger than anyone expected. Because once governments could borrow easily, debt stopped being temporary. It became permanent. By the 20th century, something remarkable had happened. Debt wasn't just financing wars anymore. It was financing everything: infrastructure, housing markets, corporate expansion, consumer spending. The global economy became addicted to borrowing. Governments issued bonds. Banks issued loans. Corporations issued debt. And every time new debt was created, new money appeared in the system. This meant economic growth became tied to one thing: more borrowing. If borrowing slowed down, economies stalled. If borrowing stopped, economies collapsed. So policymakers faced a dangerous reality. The system only worked if debt kept expanding forever. This fragile structure faced its biggest test in 2008. The global financial crisis exposed how unstable the debt machine had become. Banks had created trillions of dollars in risky loans, especially in the housing market. Mortgages were bundled into complex financial products and sold across the world. When housing prices stopped rising, the entire system began unraveling. Banks failed, credit markets froze, global trade slowed dramatically. At one point, the financial system came dangerously close to collapsing, and if that had happened, the consequences would have been catastrophic. Governments faced a terrifying decision: let the system fail, or rescue it by creating even more debt. They chose the second option. After the crisis, central banks launched unprecedented policies. Interest rates were cut to nearly zero. Trillions of dollars were injected into financial markets. Central banks began buying government bonds and financial assets on a massive scale. This policy became known as quantitative easing. The goal was simple: keep the debt machine alive. And it worked, at least in the short term. Markets recovered. Economies stabilized. But the cost was enormous. Global debt exploded to levels never seen before. Today, total worldwide debt has surpassed $300 trillion. That is more than 3 times the size of the entire global economy. And the system continues expanding, because stopping it would be far more dangerous. Look closely at every major financial crisis in modern history. The pattern repeats: a period of easy money, rapid borrowing, asset bubbles, then a crash. And each time the solution is the same: more debt. The 2008 crisis led to massive stimulus. The COVID crisis triggered even larger money creation. Central banks printed trillions in just a few years. Markets soared again, but the underlying structure never changed. The system still depends on expanding debt, and that raises a disturbing question. What happens if debt can't keep growing forever? Over the decades, economists have proposed many solutions: debt forgiveness, stricter banking rules, balanced government budgets, but these solutions rarely last, because the entire system is built on borrowing. Reducing debt too quickly can trigger recession. Cutting government spending can slow growth. Raising interest rates can destabilize financial markets. In other words, fixing the problem risks breaking the system itself. So policymakers often choose the safer short-term option: keep the machine running, even if it means creating more debt. First, modern money is deeply connected to debt. When loans are created, money enters the economy. When loans are repaid, money disappears. This means growth often requires expanding borrowing. Second, financial crises are not random accidents. They are often the result of debt expanding faster than the real economy. And history shows that this pattern repeats again and again. Third, the global financial system survives by constantly adapting. When problems appear, new tools are introduced: lower interest rates, stimulus programs, central bank interventions. But these solutions often delay problems rather than eliminate them. The truth is, no one knows exactly how long the global debt machine can keep running. Maybe decades, maybe longer, or maybe the next major crisis will force a completely new financial system. History shows that monetary systems eventually change. Gold standards end, currencies collapse, new systems replace old ones. The real question is not if change will come, but when. If this story changed how you see money, debt, and the global economy, make sure to subscribe for more deep dives into the hidden systems shaping our world, because the most powerful forces in history are often the ones few people truly understand, and the global debt machine is one of them.